Now that we're getting into the technical side of the modeling, I want to just make sure you are clear on the process. So it's this process that we're going to look at in different ways, from a very basic one-page accretion dilution analysis to a templated full-scale merger model, merging two income statements, cash flow statements, balance sheets. What's the technique for that? To the actual Office Depot, Office Max, a real case. I want you to understand the high level and how these things work. So remember, and this is just, please, if you have any questions, let me know. I want to make sure we're clear on these core concepts. The first step in any merger is getting the purchase price. And I'm redoing this because there was still some confusion on yesterday. The idea of including net debt, right? So I want to make sure we're clear on, first of all, once you get the purchase price by going through some sort of valuation analysis. There it is. Finally got to the slide. Okay. And once you have the purchase price, that is utilized in some form of sources and uses of cash. The uses of cash determining where is the purchase price, where is our funds going, right? And what I mean is it's going to more than just the purchase price, right? You're paying for the purchase price, yes, of course, that represents the shareholders. You're also paying for other things. You may have to pay the lenders, target net debt. You also have to pay the bankers, fees, due diligence fees, and other types of fees. Does anybody else need the model? Are you done? Did you take it? Anybody else need it? Just so we can have it ready? Okay, good. And then the sources is, where is the money coming from? Now, the question lies, and this question comes up in a lot of interview questions, do we have to pay down the target company's net debt or not? And that's dependent on two things. One, is the company public or private? Why does that matter? And that matters because if the company is public, the shareholders cannot be left with debt obligations. You, as the purchaser, need to maintain responsibility for the debt that's on the business. And maintaining that responsibility might either mean you have to pay off those lenders, meaning raise additional funds to pay them down, or you could just take on that debt if you want to. But you might not have a choice. And how do you know if you have a choice or not? Well, you have to look at the debt covenants. You have to look at the debt covenants. Those are clauses, those are laws that might say, the lenders might have covenants that say, if there's a major company event, like a bankruptcy or a change in control, we want to be paid back. So who's going to do that? The shareholders can't do that. You, as the acquirer, have to do that. You have to raise additional funds to pay down the net debt. They might not have that clause. They might say, well, it depends. If it depends, then you, as the acquirer, have to decide whether you want to pay down that debt or not. How do you know whether you want to pay down that debt? Well, if you end up paying down that debt, you're more than likely going to be paying down that debt by raising your own debt. So it's really going to depend on the interest rates. Are you getting better interest rates on your own? That depends. As an analyst, you'll never know. And so as an analyst, usually by default, we just assume we're going to pay down debt from the beginning. And then, let an managing director come and say, you know what, we looked at the terms, we did diligence on the debts towards the end, and we don't have to pay down the debt. So fine, so you just zero that out, and the model's going to look better. Why? So you're thinking that through. June, but I didn't mean to purposely think. Why? And this is where I want you to kind of be. I mean, maybe some of you are still working in your head the process on the board, but where I want you to be is, okay, you kind of get the mechanics of it, but why? What are the impacts? Because a lot of times in case studies, they're going to do more than say, here's EBITDA, can I see accretion dilution? It's what is impacting EPS and why? And that's what this model is going to start to illustrate. So, Amberly? Less interest expense. Yeah, you don't have to deal with that interest expense. So we'll look at that. So now it's interpretation from a high level, and then we're going to get into the deeper mechanics in the full model. Okay, sources and uses. And then it's the pro forma analysis. I'm going to go through this one more time. I want you to make sure that you are thinking about it. And the idea is, what does this do to the balance sheet? what does it do to my financials? And the way I like to think about it is first to think about the balance sheet, right? Because if you're thinking about the balance sheet is the measure of assets and liabilities. It's a determinant of what you're getting in the business. It's what the company owes and what it owns in some respects. So think about when thinking about the balance sheet, think about what you're keeping, what you're not keeping. And what you're not keeping is represented by the uses, what you're paying for, what you're paying off. Right? Your purchase price, shareholders, paying off the shareholders. Shareholders go away. The shareholders' equity goes away. And you're paying lenders. Pay off lenders, and the debt goes away if you pay off lenders. So generally speaking, when you're purchasing a target company, you're taking on everything except for the equity and the debts. You've paid off the lenders, you've paid off the equity holders. And that's why in an accretion dilution analysis, the process is you are taking on everything about the target business, adding together line by line, revenue, all the way down to net income, except for items related to the target debts and the target equity. And that's what we've been doing on the board. Revenue, acquire plus target. COGS, acquire plus target. OPEX, acquire plus target. All the way down. Interest expense, acquire only. No target interest, target debt's gone. Right? Right. Getting everything except debt and equity. Taxes, all the way down to net income. And then shares, acquire only. Target shares gone, we've paid off target shareholders. So you've added together everything except for items related to target debt and target equity, meaning no target interest, no target shares. And then you make on top of that 4 categories of transaction adjustments. Synergies, post-merger cost savings. We've looked at synergies on paper. Let's see how to model them. They're tough to project. We'll talk about them when we look at Office Depot. Actually, Office Depot Office Max centers heavily on synergies. LBO centers, interestingly enough, on synergies in a different way. This is workforce reduction. Could be revenue synergies as well. It's one category. Second, goodwill, but not just goodwill. It's a little side impact to goodwill. Goodwill is the price that you paid that's greater than shareholders' equity. Why would you pay more than what's been stated as shareholders' equity on the book value? Well, we talked about this a lot, but I'm just recapping so we can get to the model. It's because the market cap, the stock's equity, trades at a premium. Why does it trade at a premium? Let me ask you that. Why does it trade at a premium? Risk and growth expectations. There's growth expectations in the stock that they expect the company to be trading at a premium. They expect more for their risk, volatility, supply, demand, all of that.
So what happens to the target shareholder when they get paid out?
They get paid out at a premium. That's why you have to pay them more to compensate for that. And so you as an acquirer end up paying a lot more than what's been stated on the book value. So what happens to that difference? That's basically goodwill. And the problem is for an acquirer, that goodwill really provides no value. It just sits in your balance sheet. You don't get any tax deductions. It could get written off at some point. And we'll revisit this when we talk about balance sheet adjustment, full-scale model. But there are things that can be done. There are things that can be done to extract more value out of that. And one is you can categorize that gap, that goodwill, that purchase price over book value, into other segments, including intangible assets. In other words, an acquirer can make the case and say, no, there are more significant reasons why I've paid a premium. Part of it is because of the brand. And the brand wasn't properly represented. There was no asset set for the brand on the balance sheet. So that's why I'm paying more. And so you get an intangible asset appraiser in, and he might put value to that brand. So part of that purchase price over book value can be allocated to intangible assets. That you can amortize. You want amortization of that because that gives you tax deductions. That is the amortization of new intangible assets. The amortization of the allocation of goodwill to new intangible assets. That's the second adjustment. Third adjustment is new interest. If you're raising debt, you have new interest. You might have new interest. If you're raising equity to fund the acquisition, you'll have new shares. Those are the four impacts. That will give you new EPS, and you compare the new EPS to the old, we calculate the difference. And we've done that before. So if somebody asks you, okay, walk me through an accretion dilution analysis, very simple. First, you got to get the purchase price, right? You get the value of the business. Then you have to calculate sources and uses of cash. The uses of cash come in three categories: the purchase price, retirement target net debt, transaction fees. Sources of cash is some combination of debt and equity. Then you go through the merger integration process where you're adding together line by line revenue all the way down to net income, acquire plus target, except for items dealing with target debt and target equity. That means no target interest and no target shares. And then on top of that, making four specific transaction adjustments: post-merger cost savings, synergies; two, the amortization of the allocation of goodwill to intangible assets; three, new interest if you're raising debt to fund the acquisition; four, new shares if you're raising equity to fund the acquisition. That gives you new EPS. Compare the new EPS with the old, and that's your accretion dilution. That's it. That's how you walk through it. 30 seconds. It's all in the book, right? We've learned this 2 weeks ago. So we've spent way too much time on it. You should be familiar. Let's put this down in the model, and we'll talk about analyzing it. This is a mini merger model. This is extremely, extremely simple. Although people have used this in practice, I'd probably use a little bit more expanded one in practice, like the next ones I'm going to send you. But this nicely illustrates where things should go. A lot of accretion dilution analysis have all these VLOOKUPs, HLOOKUPs, all these kind of crazy Excel functionality that for instructional purposes, you lose the point as to what's going on. The purpose of this is to lay out the point of what's going on so we can understand stress testing variables. Great for an interview. You got an interview, a phone interview, you should have this open, right? Top part, considerations. We're going to lay out the assumptions. Underneath, these are the companies being merged, the target and the acquirer. We'll have to build out their quick income statement. Underneath, this is the heart of the analysis. This is the merger. This is what you should be picturing in mind when thinking about a technical merger. We'll put that together. And then we have multiples and sensitivities. That's going to be the purpose and the meaning of the discussion is to understand how different variables would affect the impact on EPS. That's kind of what I want to start to get you thinking. So we'll be done with this maybe today, maybe getting to tomorrow. And then tomorrow I want to show how this differs from an actual full-scale model that we'll build this week into next week. Okay? All right. Considerations. Let's start to build out the core considerations. The acquirer is trading at $100. The target, $70. The purchase premium is 25%. The target company is being bought out for a 25% premium above their stock price. So what is their price per share? 70 times 1 plus the percentage equals C9 equals 70 times, open parentheses, 1 plus 25%. Times the 70, yep. 87.5. They're paying a 25% premium. That's a standard premium. I mean, it can go all over the place. You can see 5%. Actually, Office Depot, Office Max with a discount. That was quite unusual. I've seen 20-25% premium. If you don't know as an analyst, just throw that in there. If you don't know what to put in there. You know, the point is, as I spoke to you in the very first week, get the model going, and then you can kind of play around and discuss the sensitivities. We will run sensitivities on this. Okay. Target shares outstanding. We can get this from below. We're going to assume these are diluted. 1,500. Okay? Got it? So the purchase price is the diluted shares outstanding times the shares paid. We've done this a lot, right? $131 million is the price that we're paying, okay? Simple, straightforward in the beginning. Okay? Someone has a question. Robbie, you know, I just addressed the premium and the averages and the standards. It is not an industry standard. It can go across the board. But as an analyst, you could probably start with 20, 25%. It's not an industry standard. Okay. Purchase price is done. Simple. We're just getting into the mechanics here and then talking about interpretation. Purchase price goes to the uses. Uses is first the purchase price. Just pull it right in. Then fees, retirement of target net debt. It's hard-coded in. The assumptions have been given. The purpose of the actual case study is to talk about how do we get these fees, how do we estimate these fees. We'll slowly get there, okay? We're slowly building to that. Leaving us with total uses. Okay? And then the sources. For now, let's assume 50% debt, 50% equity. So the key of this is to determine, bless you, what changes based on adjustment in these percentages, okay? Now, notice what I've done here. 50% is hard-coded. The debt F7 is 1 minus 50%. It's not another hard code, right? This is dependent on the variable F6, so that if I type in 25%, right, the debt is 75%. Right? The debt is automatically building off of. The reason why I did that is, okay, so fine. I mean, it has to add up to 100%, and you can do that manually. But we're going to do a two-variable data table, and a two-variable data table means this stuff needs to be only dependent on two variables. The one variable is going to be purchase premium. The other is going to be 50%. The table won't work if both these things are hard-coded. Why? Because the table is going to say, all right, I'm going to lower this to 25% and see how my results are different. Well, if the table does that and this is not dependent on that, then we're going to have a problem. We're going to have a total that doesn't add up to 100%. This first variable needs to be dependent on the second variable in order for the table to work. We can do 50-50. And so the equity, I want to see the actual equity values here. The equity value is going to be equal to 50% times total uses. And the debt's going to be 50% times total uses. Okay, make sure that that debt equals to the 50% align with the debt. Add it up. Sources must match uses. And it is. And it does. Okay? Yeah? Okay. I want to now look at acquisition multiples. I want to use this because it's going to help us run some analytics and contrast against market multiples. Make sure you know the difference between acquisition multiples or purchase multiples and market multiples. We'll start with the purchase price. Okay. And we want to add the net debt to ultimately get the enterprise value. Okay. We're pulling the net debt's given in the uses. Okay. Why do we need that? Because we're going to need market value and also enterprise value. Enterprise value is market value plus the debt, right? Enterprise value is the market value of the purchase price plus the net debt. Notice to not use the total uses as enterprise value. Some people do that. Total uses includes fees. Fees are not part of enterprise value. Okay? So first, I'm assuming you're picking up on the key difference between a purchase multiple and a market multiple. The market value is not the trading value of the company. It's the purchase price. It's the price that we're paying. It's the equity value of the purchase price. And the enterprise value is the enterprise value of the purchase price, which is the purchase price plus the net debt assumed, as opposed to the enterprise value in a trading multiple is the trading value, the trading market value plus the net debt of the business. Right? So the first difference between purchase multiples and market multiples is purchase multiples is based on the purchase price. So purchase multiples are inflated because it includes the impacts of control premium. Okay. I want to run multiples. We cannot run these multiples until we've built out all the statistics. So take 5 minutes and build out these statistics. The income statements. EBITDA, simple. Revenue minus expenses. EBIT, EBITDA minus D&A. And so on. Net income, EBIT minus interest after taxes, etc. Take a second. So I'm going to also do this. Tax rates above, cell C13. Okay. Take a few minutes, catch up. Okay, let's continue. This is what you should have, okay? We're going to use these numbers to calculate purchase multiples, all right? And so, on the top, we have these acquisition multiples, by the way, are based on the purchase price against the target company. We want to know how much are we paying for the target company on a multiple basis. Remember, the whole idea of multiples is dollar values are absolute, and you can't use them to compare. One company I paid $10 million for, another company I made $100 million for. What does that mean to me? Unless you compare it to some measure of operations or some other measure of a company's financials to get a multiples you can use to compare. So enterprise value, the 131,550, we can compare to the company's sales. Let's use 2014 multiples. Target sales. So paying 131,550, $131 million, is less significant until we realize, okay, well, what are we paying for? We're paying 13 times a company's sales. Is that high? Is that low? Well, it depends on multiples for other companies in that industry. And this is 13.2 times sales is generally high for any company in any industry. Usually enterprise value to sales or revenue multiples are usually you pay 1 times, 2 times maybe, a lot of times 0.5, 0.85 times public companies trade at. Enterprise value to EBITDA. Let's look at that. We're going to take enterprise value. We're going to divide it by target company's EBITDA. 21.9. It's also kind of high. Enterprise value to EBIT. Take the enterprise value, divided by the company's EBIT. Guys got it?
Oh, you could use multiple. Do you just always end up using the latest financials that is available? Like let's say.
Well, for an acquisition multiple, yeah. And we'll do that. We'll do a precedent for, we did a precedent for Walmart. Yeah, you usually, you want to get as close to announcement date. You want to get as close to announcement date if you have a choice. Usually you just get whatever's available because it's just so difficult to get relevant information for a precedent transaction. But
When you say not, when they first announced it, not the actual closing of the transaction, right? I don't have actually something.
I've seen them done on announcement date. I've seen them done at close also. More relevant to get it on announcement date because usually by close, especially if the company's taken private, that information is no longer available. You usually see it on announcement date.
Regardless of whether they, let's say, you have takes like 6 months and they come up with the financial.
Well, yeah. So this goes. So by default, you get the most recent financials by default. But usually, once the deal closes, they're not producing any more public reports. If you got to answer your question, yes. If it's been 6 months after announcement and you've actually gotten more recent financials,
Yes.
definitely use those.
Right.
Definitely use those more recent financials.
Release the new quarterly and after,
Yeah.
like 2 months later you close it.
Yep. Then go with the most recent.
You just go with the most recent.
Yeah. I'm just saying usually you see it just on announcement date because that's the information you have available. So, good point.
That's right. How do we get the net debt?
Net debt was given, but in reality, and we'll see this in the case study, you'll get it on the balance sheet. In the case study, we'll get there.
And the acquisition multiple based on the 2014.
Yeah.
Why?
That's the closest information that we've had to the purchase. Just kind of what June was asking. Yep. Okay, purchase price to net income. Should be self-explanatory. The purchase price divided by the company's net income. 41.2, pretty high.
How come it's too high though? Norm is like 1 or 2 times. It's not norm with that raised flag or not?
I mean, you make a good point, right? Especially with purchase price, is anything too high? And then you see all these tech companies being purchased for a ridiculous valuation. So, and then they have it justified. So, you never really know, and the situation can be different. But when I say too high, I mean for the S&P 500 trades on average 16 to 17 times. So if you're going to buy a company on average and pay a 20% premium, that's going to be what? 18, 19 times, 20 times? And this is double that. That's where I came from in saying that. But yeah, anybody can argue, well, but this is a tech company. It depends on the comps, depends on a lot of things. And this is a template, so this is not like a real company. So, you know, but these are the types of questions that I want you to be thinking about. So, right. Now, price to EPS is a per share metric. It's the price per share. What's the price we're paying? 87.5. Divided by the earnings per share. Okay, so 87.5 divided by earnings per share. 41.2. Net debt's given, Young. Yep. It's equal. It will always be equal. Why? Why is it always equal? Good. That's what I wanted to point
All
out.
of them is both of them on top and the bottom have how many shares?
Yeah. So one is just. Can you see this? One is market cap to net income, right? One is dollar per share to earnings per share, and you multiply by shares and shares, and you get that. Dollar per share times shares is market cap. E.P.S times shares is net income. So it's going to give you the same metric. The only difference is you're multiplying by shares over shares, which is 1. Multiplying by 1. It's going to give you the same metric. Okay. Good. We will analyze this when we're done. But just for now, I want to make sure you know how to get there. Next, start to lay out the consolidated statistics. Easy enough. Adding together line by line, revenue down to net income, except for items dealing with target debt, target equity. Let's do it. Real simple. You're adding revenue, acquire plus target. That's it. Right? Expenses, acquire plus target.
How do you do that?
I just did Control C, Control V. Is that what you asked?
Yeah.
Mm-hmm. Synergies. So some benefits of this mini merger model versus our paper analysis, we can be a little bit more granular. I guess we could have done the same detail on paper if we wanted to. Synergies, they suggested 3% of total expenses. So we're going to take, and I'm going to make it a negative to illustrate that it reduces expenses. So I'm going to do minus the expenses times 3%. And I'm going to anchor my reference to that 3% by typing F4. I did F4. And then I can copy this to the right to get synergies. Okay, the reason why I made it negative, you can make it positive, just so total expenses I know is the expenses reduced by the 270.
Revenue times 3%.
Yeah, it's the expenses times 3%. Expense synergies.
Saving costs, saving expenses.
Yep.
Aren't there some revenue synergies too?
You could have revenue synergies, but this didn't explain that. I mean, this didn't offer that up as an example. So the total expenses are expenses plus synergies. Okay? Any questions on that? Okay? Okay, that leaves us with EBITDA, which is revenue minus expenses. Don't do EBITDA acquire plus target because you're not capturing the adjustments from above. The acquire plus target is just with the core line items, of course. Don't make that mistake. Make sure your EBITDA is matching. Depreciation, acquire plus target depreciation. We're getting the property, we're getting the depreciation that comes with it. We'll talk about that in detail. That is just expenses plus synergies. Okay? And then we have to work on this adjusted amount of intangible assets. Okay? Yep, that we added, acquire plus target. Acquire plus target, just like all the other line items. Yep, acquire plus target. Okay, Goodwill box here. Make sure you're with me on this. Purchase price. And it has to be the equity value of purchase price always. Don't get fooled by that. Target book value is given. So the price over the book value is the difference, right? 51,250. That's either goodwill or it can get broken up into several pieces if a portion of that is allowed to be allocated to other things like intangible assets. So the assumption is, let's assume that 25% is allowed to be allocated to intangible assets and can be amortized over 15 years. Okay? Let's assume that. So we're going to take the price of our book times 25% of that, divided by 15 years. 25% of that difference divided by 15 years is the annual new amortization based on the allocation of price over book value to intangible assets. That's how you talk about it. Okay? That's an additional expense. There's an added expense. That gets linked in and copied to the right. It's the same number each time. Okay, giving you total DNA of the 2000s plus 854. So it's increased our expense. I'll give you a few minutes to catch up. Okay, EBIT is EBITDA minus DNA. And you should have 15,475.8. And actually, let's stop and take a break here. This is a good break point. Okay. What do we do about interest? Acquire only. No target interest expense. Remember that. Interest is acquire only. Right? Copy that to the right. And then there's new debt interest. This is the adjustment on the debt that we've raised, the interest on the debt that we've raised. How do we calculate that? It's the new debt from the sources. We'll anchor that so we can copy to the right times the rate, and the rate is 5%. Okay? It's a lot. Big impact to the E.P.S. and we'll add the two. Which would leave us with EBIT minus interest Questions? And the taxes are EBT times tax rate. We can anchor the reference to tax rate, copy to the right. Oops. Here's the new debt, Ricardo. Guys have questions on that? Okay, and the net income is EBT minus taxes, of course. You okay? You guys getting 7790? And shares outstanding, where does that come from? Acquire only, right? Interest and shares, acquire only. So the acquire shares, 3,000. Copy to the right. And we now calculate the new shares. You okay? How do we calculate the new shares? Yeah, good. It is the equity raised to fund the acquisition, 68,825. Anchor it. Divided by the acquirer share price. You're the acquirer. You'll be raising money out in the open market at your share price, maybe even at a discount. That's the perspective. Copy to the right. And the total new shares is the original acquirer plus the issued shares. With that, we can calculate our earnings per share by taking the net income divided by those shares. Okay? Everyone have that? 213? Is that accretive? Is it dilutive? Let's take a look. We compare this to the original acquirer's EPS. This EPS minus original acquirer. It's almost break even by the third year. We can calculate the percentage change, new divided by old, minus 1. So it's dilutive in the first year, becomes less dilutive, break even. You'd hope in the next years the trend means it'll become accretive. What is impacting this dilution in the first year? What's impacting accretion and dilution? Because there's both going on in any case.
What the cost saving thing, that's what's going to eventually make the accretion.
Cost savings. What else?
Plus the revenue and
What else? Cost savings.
also you have to issue more shares, the E.P.S.
What did you? Amortization.
You have to issue
Issuing shares. So synergies is actually creating accretion, right? New interest is dilution. New shares, dilution. What else? The amortization is dilution, debt, interest we mentioned. What else? What's the biggest factor impacting this altogether? Should be the first thing you mention. Very important. If somebody says what impacts accretion or dilution, it's biggest impact. What? What do you mean? The target's E.P.S.
Right, of course, yeah.
Yeah, it's $2.12.
The lower that would be, the more dilutive.
Yeah. So if somebody says what impacts accretion dilution, first it's the impact of the target company's E.P.S. into the acquirer. That's accretive. Synergies on top of that, accretive. Weighted down by the impact of interest on debt, the impact on the amortization, and the impact on the new shares. That's the way you should be thinking about accretion dilution. One offsetting the other. and the impact on all these costs are greater than the positive impact of bringing on the target company in the beginning, and then it slowly becomes accretive. Let's look into that more. Before we do that, let's just run now the companies together. We have acquirer pro forma multiples. Okay, so these are basically, let's look at how the new company combined will trade in the market. In other words, the market value is the new market cap. How do we get that? It's the new shares, the 3658.3, times, and let's assume the company is going to continue to trade at the same price that the acquirer has been trading by. Although usually, historically, in an acquisition, in a small acquisition, no, but in a large acquisition, the acquired stock price will go down. Yeah, by 5%.
Is it a merger that is good news? Is bad news, I guess?
It's good news, but it's just going to go down a little bit because there's just a lot more shares out in the market. Small amount.
Talking about the acquirer, right?
Mm-hmm.
Yeah, most always.
So let's, yep, absolutely. So that's 365,825. Market value. Okay? You guys get that? And then we want to get enterprise value, so we need the acquirer's net debt. If you notice, we have not gotten the acquirer's net debt yet. We haven't utilized it. So the acquirer's existing net debt, the debt that they've had on their balance sheet, is not the complete picture of net debt. Why? We raised a bunch of debt. So we got to bring in the new debt raised, which we have up above. Anchor that so we can copy this to the right. Do this for all 3 years. So the total debt that we have now is the new debt raised plus the acquirer's old debt. Target's debt's gone. Target's debt's we paid down. Bless you. So the enterprise value is that new debt plus the market value. Okay? And with this market value and enterprise value, we can now run multiples. Enterprise value to sales. But this is based on the combined company sales. Enterprise value to EBITDA. Combined companies EBITDA. EBIT. Combined companies EBIT. Make sure you're getting that. Then there's market value to net income, which is the market value, of course, divided by the net income. And then price to EPS. What price do we use?
Market value.
No, that's market value. What price? Yeah, the acquirer share price. The price that the company is trading at, which we assumed was 100. Anchor that, divided by the EPS. You'll know you're right if the numbers match because we mentioned on the board market value and net income is the same as price to EPS. Okay, you guys got that? I want to know, based on key variables, how my earnings per share accretion or dilution can move, can change. Right? This is the importance of these discussions, is it's the interpretation as well as being able to build the model. Right? This is what they ask you in case studies. Right? It's the interpretation. So what variables, what are the key variables in this analysis? Let's go in order from the start to the end. So we have an organized approach. What's the first variable? Premium. Then what?
E.P.S. is
Not yet. Not yet.
Much cash you have again?
Not yet. Purchase price, yeah. What else? The targets, net debt. The value of the net debt, the covenants, right? What else? Transaction fees. Good. That's the way to think about it. Purchase price, uses, then sources. Now what? What else? Sources. Debt equity split. Or cash on hand. The company has cash on hand. Now, E.P.S. Now you got the purchase price, you got the sources and uses. Now the company's financials, the acquirer and target's financials. You'd combine them. What else then at this point are variables?
Interest rate will matter too, right?
Interest rate, what else?
Tax rate.
Tax rate, what else?
Synergies, cost saving synergies, you know.
Cost saving synergies. So start with that. Go top down. Synergies, what else?
Synergies, interest debt. Synergies, interest tax.
One more. Amortization. Synergies, amortization, interest, taxes, shares. Those are all the variables. In the beginning, arguably, the first one is the purchase price, premium. How much are you really going to negotiate for your shareholders? If your premium goes up or it goes down, what impact will that have on EPS? Important sensitivity to have to determine what's your window in negotiating to make this accretive or dilutive. That's one variable. A second common variable is the debt equity split. Should I be raising debt to fund this business or should I be raising equity? So a common sensitivity analysis is around the debt equity split and the premium. So that's what this sensitivity table is supposed to read. It's supposed to say, okay, well, what if my premium changes from 5 to 10, 15, 20, 25? Or what if my debt equity split switches from 0, 100 to 50, 50 to 100, 0 the other way? So we're going to fill out this table by running sensitivities on this. And for example, what we're doing right now is we're running the 50-50 case, 25% premium. So let's say we want this table to be populated with varying 2016 sensitivity. What would happen if our premium changes or our debt equity split changes? How would our 0% accretion change? So right now,
Why do you use 16? Why do you use 14? Is that for the
you could, right at 50%, right now, 50%, the 50-50 split is here. The 25 case is here. So basically 0% should be populated here. So I just want to finish that thought before I answer your question. You could do any year. To me, 2016 is more representative of where people want the company to be because it's always going to be dilutive. You could do either way. Okay? If we were to say, want to fill out this data point, which is 0% equity, 15% premium, then we'd go up here and we'd say, all right, well, 0% equity, 15% premium, running that scenario gives us a minus 4% dilution. So that was 0.15, so minus 4% is here. You see?
I would do 130, right?
You could. So we could do, okay, 100% case. 100% case here. 30% premium. Right? And so this is why I mentioned in the beginning. I don't want two variables here. I want one variable. This is dependent on that variable. This is 100, this must be 0. You see what I'm saying? That gave us 6% accretion. So I'll put 6% here. Okay? That's the way I want the table to be populated with and filled out. Okay? But there's a way to automate this. Right? You would automate this. Oops. No, 100% equity. This is 100% equity. This is equity versus premium. The way to automate this is by running a two-variable data table analysis. So let's just, so we're all on the same page, let's just put this back to 50-50 and to 25%. Okay? So we're all on the same page. And the E.P.S, the way a two-variable data table works is first in the upper left corner of the table, you need a link in from the model that represents what you want the table to be populated with. We want a link in from the model that represents what we want the table to be populated with. We want the table to be populated with 2016 E.P.S percentages. So in the upper left corner, we want to link in from the E.P.S accretion dilution percentage. We want the table to be populated with varying degrees of E.P.S accretion dilution percentages based on the adjustment of two variables. One variable needs to be laid out to the right of that link, the second underneath. And then you highlight the entire table. It'll overwrite what you put in there. It'll highlight the entire table, including the variables. And you run the table by either doing Alt-DT, or you can go to Data, and everyone, depending on your version of Excel, Data, What If Analysis, Data Table. Okay. Where the row input cell the row input cell is basically asking for an input. It is saying, of these variables across the row, the 0, 50, 100, where does it need to go to change that variable? So you've got to be careful. When you're running a two-variable data table, you need to be sure that when it changes that variable, it actually changes the answer. Otherwise, it won't work. So to change the equity percentage, you have to go to F6. It's the row input cell. And the second question it's asking is, of the percentages up and down the column, where does it go in the model to change that? That's the percentage premium. That's C8. Okay? Then when you hit OK, it should populate the table, give us everything. And what's nice about this is it's dynamic. So if you end up changing your model, changing your assumptions, this will constantly update. The drawback is it slows down your model. But won't be a problem here. Could be a problem in big, big models.
So obviously that's usually years away.
Okay, well, let's analyze this. But first, does everybody have this? I mean, need help with putting this together?
Well, you know how you mentioned at the top when we were talking about the sort the split interconnected and sources. You said it has to be one variable.
Yeah.
One variable.
Mm-hmm.
What's an example of severe? What did you mean by like it has to be two variable?
It means like the debt has to be like 100 minus the equity, right? So that's
An
right.
example of like something that's not kind of bad. Like what could have someone screwed up where that's what I'm
I see what you're saying. If so, this is variable 1. This is variable 2. Okay. If I had hard-coded debt at 50, the table's not going to work anymore.
Oh, I see. Oh, I see.
Because
Got it. Okay.
it's giving me different numbers.
So
Because when the table goes in and says, all right, I want to run this 100% equity case, the table goes up here, it runs 100% equity, and this is what it's seeing. It sees a 150% case, which doesn't make any sense. You can't have 150%. So we need to make sure that this is always 1 minus, there's no such thing as a 3-variable table. No, I don't think so. That's what I'm saying. Does everybody have this? If you don't have this, then either your table is put together improperly, or something's wrong in here. You can look at it later. Now, trends. What's going on here? Does this make sense? As our premium goes up, it's getting more dilutive. Does that make sense? Why?
To pay more.
And why does that make it more dilutive? What do you mean?
You have to raise more shares in order to pay that.
You have to raise more shares.
Which dilutes
Okay.
earnings.
Okay. Now, as we go to the right, when we go from 0% equity to 100% equity, it's accretive then. Why is it accretive? We're raising more shares.
Because the less debt, the less interest you get.
But you just said if you raise more shares, it's more dilutive.
No, to the right. It's not about equity.
This is raising more shares.
I mean, if you just look at the 0 to 100, it's kind of more accretive. Right?
Why?
Because if you just focus on that, it just means you're raising maybe interest in that area.
Okay. Let's go back to premium. What about raising the premium is causing it to be more dilutive? Yes, fine, you're raising more shares. What else? Increasing the premium. What else is impacting the dilution? Raising more shares. What else?
Transaction fee is higher, right?
Higher? No, not in this case.
are you not like basically amortizing more? So
More amortization.
and that
Purchase price is higher. What else?
Tax.
More taxes. What else? What else is changing?
Less interest.
More interest, right? You're paying more.
pay a higher.
Price?
Oh, I see.
More sources.
Got it, yeah.
Higher price? The net debt's fixed in this case. The fees are fixed in this case. More equity, more debt raise. More equity raise means more shares. More debt raise means more interest. Okay. Now, if you notice, yeah, you're going from 0% equity to 100% equity. The more equity, the more accretive this is becoming. Why is that the case? Does that make sense? It makes sense.
I don't know if it makes sense. But
Why not? Does it make sense?
If it does make sense for me, it'll be because less interest on the debt they raise.
Okay, does it not make sense to anybody?
It doesn't make sense.
Why?
Because you raise more shares outstanding, the shares outstanding increase. So I guess actually the shares outstanding is less impactful than the interest. Is that why it's happening? Because even though you raise more shares because it's more equity, the interest you pay on debt more.
Yeah. What's the difference? What is the difference between raising debt? This is all debt to fund the acquisition, or raising all equity. What is the difference in EPS impact? Raising debt is what?
More diluted.
Yeah, but why? Yes, but why? More interest.
Right.
Raising equity is?
More less interest.
Less interest, but what else?
More shares.
More shares.
Right.
What has a greater impact to the
Obviously
EPS?
interest in this case, right?
But just generally. No, it's not obvious.
I mean,
That's what I'm trying to get to. Of course. We talked about this the first day at M&A. Coming full circle.
I know cash is best, but cash is probably best.
Okay, but we're talking equity debt. Equity versus debt. Standard pre-M&A knowledge. What is more impactful to deep?
Does it depend on the cost of
Just what's the answer? What's more dilutive, equity or debt? Equity. Equity is more dilutive. Okay. Why?
There's a premium.
Why? Why is equity more dilutive than raising debt?
More risk involved.
More risk involved. Why is that not being seen here? So if I ask you, is this normal? It's not normal. Why? You said it, not me.
So the risk is low, right? So the risk is low. The risk is low. For that.
Why is it low?
That reflects, I guess. The risk is low.
Is it low? What's happening? What is driving dilution in raising debt again? It's based on what? What's the variable?
Interest rate.
Interest rate. What about raising equity?
It's 5% is very low. Actually, no.
Okay. Stock price. Stock price. Stock price. Stock price versus interest rate is what impacts dilution on raising debt versus raising equity. So typically, the impact on equity is more dilutive. Why? Because there's risk involved. So what does that mean? What does risk have to do with those numbers? Higher returns required. So what does that mean?
You get to pay more.
Who has to pay more?
The acquired has to pay.
Okay, but what does that mean for one of those variables?
It means the stock price will be higher usually.
Stock price. Right? You would hope that investor has baked the impact of risk in that stock price. So what's happening here then? Either the interest rate,
Oh, that target stock price is low? Is that what
either the interest rate is so high that's more dilutive than raising equity. But you made a good point. Interest rate is not high. It's 5%.
The target stock price is lower. That's why.
How do you determine that?
I mean, it says it. It says it right there.
What do you mean it says it?
Target stock price lower. Acquired is 100. Target 7 there.
Oh, the target stock price is lower than the acquirer? That might not help. What do you have to look at? Target stock price in relation to, Amberline? Then what? Compared to what? Not necessarily the price,
Market cap.
not necessarily market cap,
Yes.
not necessarily the EPS.
Say everything.
Average? Huh?
I said just say everything.
Just say everything. Just blurt it all out. You'll hit it at some point. What else? Very important.
Your question, how do you know you're not overpaying or underpaying?
Yeah. Very simple. Very simple yet very important.
See what's
What is the,
if you're not overpaying for the company.
how do you determine that? You look at the,
Share price.
not the price. Is the PE multiple? The PEO multiple. You all failed your first round valuation interview. How do you determine if a price is valued? PE multiple. Right? Multiples determine if a company is overvalued or undervalued. PE multiple. The PE multiple was our company. So when somebody says, and we'll get to this, how do you determine if a company acquisition is accretive or dilutive? You can run an accretion dilution analysis, but even before that, you look at the PE multiples. I'm trying to get you to understand why.
This is, 41, kind of high.
Let's look at it. What's the PE multiple?
41.2.
That's the acquisition multiple. You look at the PE multiple of the acquirer's business, because that's the metric, that's the price that they're raising equity at, right? It's the PE multiple of the acquirer versus the impact on debt. And what's the PE multiple of acquirer? Well, roughly it's 100 at about $2 a share. They're paying 50 times multiple. 50 times. Is that high or low? That's high. But investors are willing to pay that. So the point is, if investors are willing to pay an exorbitantly high price for your stock, what does that mean?
Expecting high growth.
Well, maybe they're expecting high growth, but then technically today, what is happening? A company can meet their funding needs by giving out less piece of the pie, giving out less shares. Right? This company can be raising $100 million by giving out 10 shares if somebody's willing to pay a ridiculously high price for it. And so this is why in situations where companies are very, very highly valued, bankers say, go out and raise money. The market's great. Go out and raise money. People are paying a lot of money for your stock. You can get a lot of value for your stock. You don't have to give out as much to get a lot in this case. And so in times of high valuations, like let's say 2000, 2001, a lot of companies were going out there raising money, and then what are they going to do with all that money that they're getting from the investors? They'll go out and just make big acquisitions. And why are they doing that? Good example of that is the acquisition of Time Warner by American Online. That was a great one. Great example of a company that was valued at a ridiculous valuation. People got excited about putting money into that company. Like, what are you going to do with all this money? Let's buy a big multi-billion-dollar company with a lot of fixed assets. Time Warner.
You know why last year?
And they did it.
You see a bunch of acquisitions.
Yeah. And they did it. And so what the impact, yeah. And so what happened though? So when that happened, traditionally, and this was an all-stock deal. It was a stock swap, 100% equity. Why? Because American Online was able to give out a little bit of shares, get a lot of money, and buy this big company. So traditionally, the idea is, well, raising equity will be more dilutive than raising debt.
Not in the bull market.
In this case, raising equity was very accretive, and the model showed that. So a lot of articles came out saying, well, CAPM doesn't exist anymore. CAPM is wrong. Because CAPM is the model that states more equity means more dilution. Why? Because that's commensurate with the risk that an investor is taking on. So what went wrong in that situation?
People were undervaluing the risk.
People were not valuing the risk. Why were people undervaluing the risk? This is
Well, in the bull market,
Everyone's like, yeah, it's
in the bull market.
bull market, everyone's excited about technology. This is the first time that Ameritrade is coming out, E-Trade. You don't have to go through a broker. To a lot of maybe unintelligent investors in the market, right? CAPM, unsophisticated. I'm sorry. You got to keep me in politically correct. CAPM works when the constraints that every investor is rational. There are a lot of irrational investors in the market. But when American Online bought Time Warner, there are all these articles coming out saying CAPM doesn't exist anymore. This is a new market shift, new market paradigm, right? But the debate against that is maybe there's just a lot more irrational investors out in the market. Maybe this is not a smart acquisition. And so what happened? A few years later, they didn't get their value. Stock price dropped. A lot of investors sold, and they had to write off a lot of assets. There was value destruction. Right? So important to realize that if those investors were savvy enough to see this going on, they would realize that they are paying an exorbitantly high price for this company, and the chance not commensurate with the risk. They'd be better off lending debt.
I mean, they probably knew this, they just thought that.
I don't think they knew it. You just have to think about it. I'm talking, they raise money from everybody, right? You go down, put your credit card online for the first time. In 2001, that was novel. Okay, I got $1,000. Let me buy American Online. There's the hypes there. It's all over the papers. That's what's causing it.
I thought we were talking about the.
Money market managers? No, they were smart enough to avoid that and to short it.
Yeah, I thought we were talking about.
Oh, the market makers? The market makers made a lot of money off that stuff.
That's what I was.
Yeah. No, I'm talking irrational investors.
Talking about the retail investor.
Yeah. Now, okay, what happens if this acquisition was appropriately valued? What happened if the stock was not 50, if the PE wasn't 50, but was, what's an average, 15? We should see a normal trend. We should see the raising equity case being more dilutive than raising debt. How do we do that? How do we force the PE from 50 to 10? Lower the share price from, let's say if the acquired share price was 30, then 30 divided by 2, E.P.S, the PE would be 15. So if the acquired stock price was more appropriately valued, we should see a normal trend, and here we do. More dilutive. If an investor was smart enough to see that, they'd say, I'm not paying $100 for this price. If the collected investor would see that, they would not pay $100 for the price, and they would wait until the stock prices come down. Right? It's supply and demand. But they didn't, and they kept paying for it and perpetuated that $100.
So how does a firm go? Let's say they want to make a merger, when they want to raise the shares. How do they do that exactly?
How do they go out and raise the shares? You mean what's the process?
There was a process. So the SMT team will probably go try to sell it? Or?
Yeah. The process we'll get into when we look for office to office max. That's a longer discussion. Don't forget to ask that question. But it is a process. Yeah. Mm-hmm.
Also, in this case, like because the PE multiple is so high for the acquirer, much higher than the target, is that why that whole effect is reversed?
Yes.
That's the primary reason. So let's say as an investor though, because my prices are overvalued by the market and I can issue lower number of shares to acquire the target company, wouldn't I want that to happen so that when that, let's say all that goes well and the synergies actually exist, I can go in and then because the acquiring company was overvalued at the very beginning, it should kind of go back to its normal price and then I can buy it during that time. Or, oh, you were shorted.
Shorted.
You were shorted.
This is why people say if the acquiring company's PE is greater than the target company's PE, it will most likely be accretive. The acquiring company's PE is higher than the target. If the acquiring company's PE is lower than the target PE, it will be dilutive. That's only true in the equity case, because in the equity case, the PE matters. In the equity case, the acquirer is raising stock in the market. In the debt case, PEs don't matter. In the debt case, you're not raising equity at all. In the debt case, PEs have no impact on this. Shares aren't changing. In the debt case, it's just interest. So this good private equity investment banking, if your question is, even before accretion dilution, I mentioned before, how can you determine the impact on the acquiring target financials? You look at the PE multiples. Only true in 100% equity case. If not, you can't do it.
As a company, that's a good thing, right? If people are overvaluing my stock.
Yeah,
Okay.
it is. It's a bad thing for the market, good thing for the company. But that's why if your company's overvalued, usually they say markets are buying your stock, go out and give them what they want.
The flip side is that it can crash.
Yeah, okay, I was going to say. And the flip side is you want to make sure your growth expectations are meeting the demand, so you're perpetuating that stock price. Stock price goes down. Look at AOL Time Warner.
Guidance, like they don't want
Yep.
market
Yep.
control.
Yep. Fair point on that side, absolutely. I hope this will illustrate that. I hope this illustrates the idea of debt, equity. Equity should be more dilutive. In the cases that it's not, it's if your company is overvalued, and this is why. Why is it overvalued? Stock price is high. Why is stock price high? The markets are dictating that. Could be irrational investors, people pushing the money, maybe unrealistic growth expectations, hype, headline risk, headline impacts.
Try initially start with 50-50 and then with the 750, and then after we're all done, you just 750, you determine what's the best.
It's a good angle to take it at if you want to. I think this is a good takeaway though. Okay, I'm going to send this to you guys. Let's stop here. Tomorrow I want to talk about how this differs from a full-scale model and start getting into the full-scale model. Okay. Thank you.